Just days ago, silver was flying. Prices surged toward the $120 level. Headlines were exploding. Social media was full of predictions. $150 silver, $200 silver, even higher. For many investors, it felt like the long-awaited breakout had finally arrived. But then, almost overnight, everything changed. Silver didn't just dip. It didn't just correct. It collapsed, falling roughly 30 to 40%, all the way down to the $80 range. And suddenly, the narrative flipped. Excitement turned into confusion. Optimism turned into fear. And the big question became, what just happened? Was it manipulation, a coordinated attack, or was it something much more simple and much more uncomfortable? According to some analysts, the answer lies in basic market mechanics. Not conspiracies, not secret plots, but something that has destroyed traders for decades. Leverage, the feedback loop that created the spike. To understand the crash, you first have to understand the rise, because the two are connected. The silver rally didn't happen in a vacuum. There was real demand, long-term buyers, physical accumulation, what some call steady stacking. This kind of slow, persistent demand creates a strong foundation, but it also attracts another type of participant: speculators, futures traders, leverage-driven investors. These players don't buy silver with cash. They borrow. They use margin, and sometimes they use extreme leverage. In some cases, up to 20 to 1. That means for every dollar they actually have, they're controlling $20 worth of silver. And when prices are rising, leverage feels like magic. Your profits multiply, your account grows rapidly, and confidence turns into overconfidence. But here's the problem. Leverage is like stacking dry wood in a forest. It looks harmless until a spark appears. And in this case, the market became a pile of dry tinder, huge leveraged positions, massive speculative bets, and very little room for error. The first downtick. Eventually, the price stops rising. Maybe it stalls, maybe it dips slightly. Maybe there's a piece of negative news. It doesn't take much. Just a small move downward. But for leveraged traders, that small move is magnified because their positions are so large relative to their capital. So the first wave of traders gets margin calls. They're forced to sell, not because they want to, but because they have to. That selling pushes the price lower, which triggers more stop losses, more liquidations, more forced selling. And suddenly, the feedback loop reverses. What was once pushing prices higher now starts pulling them down fast. The cascade. This is what's known as a liquidation cascade. One forced sale leads to another, and another, and another. It's not emotional selling. It's mechanical, automated, triggered by margin rules, algorithms, and risk controls. And because the rise was so extreme, the fall became equally dramatic. In other words, the crash matched the spike, not because of manipulation, but because of the same force that created the rally in the first place: leverage. When leverage builds up, it creates explosive upside, but it also guarantees explosive downside, a natural but painful correction. From this perspective, the crash wasn't unusual. It was almost inevitable. A market that rises too fast, with too much leverage, eventually has to reset. And when it does, the correction is rarely gentle. It's violent, it's fast, and it leaves a trail of destroyed accounts behind it. But here's where things get interesting. Because the biggest impact of a crash like this isn't just the price drop, it's what happens next. The market is no longer stateless. Before the crash, many traders believed silver could only go up. Every dip was bought, every rally attracted more leverage. Confidence was high, maybe too high. But after a 40% crash, the psychology changes completely. The market is no longer what some analysts call stateless, meaning participants no longer forget the past. Now the market becomes stateful. It remembers, it carries emotional scars, and those scars affect future behavior. Traders who got liquidated won't jump back in as aggressively. Investors who bought near the top will hesitate. And leverage will feel a lot more dangerous than it did just days earlier. Some traders didn't just lose money. They were, as one analyst put it, slapped by the market. Others were carried away in a body bag. And that kind of experience changes behavior, sometimes for years, which even if the fundamentals haven't changed, the psychology has. And psychology drives markets, just as much as fundamentals do. So the real story of the silver crash may not be about manipulation or secret conspiracies, but about something far more common: a classic leverage cycle, a feedback loop, and a painful but natural reset. But there's another part of this discussion that has sparked huge controversy: the role of the CME and its decision to raise margin requirements during the rally. Was it manipulation, or was it something else entirely? That's exactly what we'll break down in part 2. So in part 1, we talked about the leverage cycle, how massive speculative positions created a feedback loop on the way up, and how that same leverage triggered the brutal crash on the way down. But there's one issue that sparked more debate than anything else: the role of the CME and the decision to raise margin requirements during the rally. Many investors called it manipulation. They claimed the exchange was deliberately trying to crush the price of silver, to protect banks, to protect the dollar, or to stop the bull market. But not everyone agrees with that narrative. In fact, some analysts argue the exact opposite. The role of the CME: manipulation or risk management. To understand this, you have to understand what the CME actually is. It's not a hedge fund. It's not a trading desk. It's not a speculative player. The CME is a clearinghouse. Its job is simple: make sure trades settle, make sure no one defaults, and make sure the system doesn't collapse. When volatility increases, risk increases. And when risk increases, the clearinghouse has to protect itself. That's why margin requirements exist. They're not there to punish traders. They're there to ensure everyone can pay their losses. So when silver prices started moving violently, the CME raised margins, not as a conspiracy, but as a risk control measure. From this perspective, the exchange wasn't trying to crash the market. It was trying to prevent something much worse: a systemic failure, a default, or even a force majeure event. And here's the irony. If the popular theory is true, that silver prices are suppressed by massive leveraged short positions, then higher margins should actually help the bulls. Why? Because higher margins force short sellers to close their positions. And closing a short position means buying. So instead of being angry about margin hikes, some analysts say investors should see them as potential fuel for higher prices. But again, reality is more complex, because margin hikes don't just affect shorts. They affect everyone: long traders, short traders, retail investors, institutional funds. And if the market is heavily leveraged, margin increases can trigger the very liquidation cascades we talked about earlier. So the CME's actions may not have been manipulation, but they still acted as a catalyst for the crash. The bigger lesson: leverage is not durable. According to this analysis, the real takeaway from the silver crash is simple: leverage is not sustainable. It works until it doesn't. It feels powerful until it destroys you. And when a market becomes dominated by leverage, corrections become inevitable. And when they come, they're usually brutal. The silver crash was a reminder that markets reward patience and punish excess. China's treasury sales. What's really happening? Another major headline surrounding the metals market was China's selling of U.S. treasuries. Many commentators framed it as a political move, a sign of financial warfare, or an attempt to attack the dollar, but some analysts offer a more practical explanation, one rooted in how central banks actually operate. You see, central banks don't hold stacks of physical cash. When they hold dollars, they hold them in the form of U.S. treasuries. So when China sells treasuries, it's not necessarily dumping dollars, it's just changing the form of its reserves. And the real motivation may not be political at all. It may be defensive. China has faced significant capital outflows, citizens moving money out of the yuan and into dollars. To maintain currency stability, the central bank may need to sell treasuries and use those funds to defend the yuan. In other words, what looks like a geopolitical attack may actually be a domestic currency defense strategy. The fundamentals haven't changed. Despite all the chaos, one thing remains true: the underlying fundamentals haven't changed dramatically. Yes, silver crashed. Yes, volatility exploded. Yes, traders were wiped out. But even after the drop, silver around $80 is still historically high. And the long-term drivers, industrial demand, monetary uncertainty, global debt levels, currency instability, those factors didn't disappear overnight. What changed was the leverage and the psychology. The market was overheated, speculators were overconfident, and the crash reset that excess. A new, more cautious market. After a shock like this, the market behaves differently. Traders become more careful. Leverage declines, and rallies become more measured. The wild euphoria gets replaced by caution, at least for a while. And that shift in psychology may be the most important outcome of the entire event. Final thoughts. So what really caused the silver crash? According to this analysis, it wasn't a secret plot, it wasn't a coordinated takedown, and it wasn't a single news headline. It was a classic market cycle, a leverage-driven rise, followed by a leverage-driven fall, a feedback loop, a liquidation cascade, and a painful reminder that markets don't move in straight lines. The real lesson here is simple. Leverage can amplify gains, but it also amplifies losses. And when the tide turns, it turns fast. In the end, markets transfer wealth from the impatient to the patient, from the overleveraged to the disciplined. And the question every investor must ask now is, after this crash, which side of that equation do you want to be on?